Thank you for joining us for our webinar today, What is My Practice Worth? Valuations as Value Drivers Before Transition. Before we get started, I wanted to mention that there's a chat feature for this webinar, and you can ask your questions at any time during the presentation. The chat button is at the bottom of the PowerPoint as you hover over it. We will answer all the questions at the end of the webinar during the Q&A portion, but feel free to ask questions via chat as you think of them. Our presenters today are Kelly Bradley and Justin Chesbrough. Kelly and Justin are both CPAs and principals with SVA's Dental Services Group. They provide advisory, accounting, and tax services to dentists and their businesses. They work with dental practices of all sizes, from solo practices to group practices with multiple locations. Kelly and Justin use their knowledge of the dental industry to help dentists on many aspects in their practices, including our topic today, valuations. And with that, I will hand it over to Justin to get us started today.
Thank you, Jennifer. Please advance the slide. So today our topics are going to be valuing a practice, then value drivers, and ultimately preparing for sale. So before we move on, I want to just tell a brief story. I hope everyone's summer's going well. Our kids have been off of school for 2 weeks. So week number 1 was anything goes, you do what you want, decompress from school. This week was my wife created a structured checklist, accomplish all these items, and then you can do what you want. I got home a little bit later last night, and I wanted to watch the Stanley Cup. Before I could, my son said, "Dad, did you complete your checklist? Did you brush your teeth?" "Yes." "Did you put away your laundry?" "Yes." "Did you exercise for 30 minutes? "No, failed. I did not do that." So I spent the first 30 minutes of the game doing jumping jacks and sit-ups in my basement. But the point being, my wife created structure for them, and she created expectations. So we like to approach the valuation process in a structured way. And what that does is that you create this structure from the get-go, create the understanding, it will lead to less miscommunications throughout the process. So the approaches to value. And I even want to start out and say, so in general, so for a true valuation, there's a purpose, there's standards, and there's premises. And you have to understand the purpose of the valuation first before you can even move on. And what I'm asking, or what I'm stating there is, if there was a situation where someone passed away and you had to value it for an estate piece, or if there was a litigation case and you were dealing with a divorce, there could be different standards of value that you follow. And that's only important to know is if you're out in the marketplace and you're hearing people talk about value, there may be misconceptions if you do not understand the purpose, standard, or premise that they did this valuation off of. So that can lead to misunderstanding. So don't simply just hear someone say in the marketplace, "I got this multiple," for example, and say, "Oh, that's what I can expect from my practice." You have to understand the background to understand how they came up with that value. So now getting into the approaches that we have here. So number 1 is an income approach. So when you value a practice, you can look at the income, and what it's getting to is the cash flow of this entity. And typically that's done under 2 main methods. One's called a capitation method. And you are looking at 1 year's income stream and then coming up with a rate based on that. So that, in general, can and should be done if it is a mature practice that is stable and has an expected level of growth. You're looking at 1 year, and you are projecting out into the future the value of that practice based on that 1 year. The second would be a discounted cash flow, where you are looking at the next few multiple years of that practice, the cash coming in, the cash going out, and then you get to that point where there is a stable period, and then you're projecting off of that. So 2 ways to look at the income of the practice to get a value. So number 2, asset. So it's a blend of appraisals, and income or market approach. So in the assets, you're really breaking apart all the assets of the practice and coming up with a value of the pieces to get that total value. 3, the market is looking at comparable sales. So this is going out to the market and seeing what other similar practices have sold at. there is a fourth that is not an approach, but is often what we hear people talking about, and that's rules of thumb. So many people will hear rules of thumb out in the market, and that's perhaps a percent of your revenue. We hear a lot of people say, hey, I know this dentist just sold a practice for a percent of his collections. He or she, I'm expecting to get a similar percent of collections. EBITDA could be another one. Earnings before interest, tax, depreciation, and amortization. A lot of people will talk about multiples of EBITDA. When you hear these multiples talked about, that is purely a rule of thumb, which can get you ballpark and oftentimes can be a good smell test for a value of a practice, but that's what we would call a napkin valuation. It's not a true valuation. It is a napkin valuation that I would not rely upon for the purposes of a transaction that I expect a lot of the participants are thinking about or looking at. So moving on to the next slide. So what are you selling? So you are selling the asset. So it could be an asset sale, which would be tangible assets and intangible assets, or there could be a stock sale. So what are the biggest differences between, I guess, an asset sale or a stock sale? So in an asset sale, it's often going to have a higher price because you are just purchasing or selling the assets and the liabilities are excluded. A stock sale is everything. So for a stock sale, I always like to tell people that in a stock sale, the seller is stepping out of their shoes and the buyer is stepping right into those shoes. So you are inheriting everything that came along with that practice, including contingent and past liabilities that you were aware or were not aware of. In general, we try to shy away from a stock sale unless it is a situation where you are already part of that practice. Maybe that you have been working there for multiple years, you understand what's going on there, and that you are comfortable that there are not hidden liabilities there. Oh, Kelly would like to just step in for 1 minute.
This is Kelly Bradley, so I'll chime in here. The other thing to keep in mind that for the tangible asset or the asset sale versus stock sale is there are fairly significant tax ramifications for the seller based on what method you use. What we're primarily seeing is, in fact, I can't think of a stock sale I've seen in the last 5 years of a dental practice. So they're almost all primarily asset sales. The main reason being is liabilities. The buyer does not wish to assume the liabilities of the seller. Back to Justin's comment about stepping into the shoes. What that means is the corporation stays intact or the entity stays intact. So along with that goes all potential liabilities. Well, a buyer typically does not want to do that. So they will form their own entity, start fresh, and simply acquire the assets that they want to purchase from the seller's practice, your practice, and move them into theirs. Now, as a seller, you would much prefer a stock sale. From the liability standpoint, that certainly is one issue, but mainly it's a tax issue where when you are selling the assets of the practice, depending on the asset mix, there are different tax rates that go along with the sale. Ordinary income is going to be a portion of the sale. It's going to be taxed at your marginal income tax rate as an individual. And then there are more than likely will be some capital gain associated with that. So you'll have a blend of ordinary and capital gain rates. In a stock sale, you're getting 100% capital gain rates on the proceeds. So it's always part of the negotiation and something to be prepared for that as the seller, you would love to sell the stock. Have a much lower marginal tax rate on the proceeds, put more money in your pocket. The buyer does not want to buy the stock. A, they don't want to take on the liability, and B, if they buy stock, they get no tax deduction for the purchase price because it's all just like you were buying a stock on a publicly traded market. You're buying Apple or GE. You have to wait until you divest of that stock to gain the basis and thus the tax benefit of it. So another main thing to remember as a seller, certainly if you can get a stock sale, get it. I would not expect that to happen. And then just understand that the difference between those has a tax ramification, and you should take that into account during the negotiations.
And that's, so Kelly brought up a lot of good points there. And that kind of gets back to why it's hard to simply just hear what someone else bought or sold for, not knowing the negotiation piece, the tax implications, a potential consulting agreement that came with it, that really ultimately gets down to, hey, what's the net cash after taxes that we're talking about? If you're just focusing on this one multiple or revenue number, you do not know all the pieces that went into that. So we talked about what are selling. So now our next slide, we're going to talk about the tangible and intangible assets. So let's start with the tangible assets in a practice. What are they, and how could you measure or calculate these? Intangible assets are often much easier to calculate than the intangible. We'll start with that. So accounts receivable. Are the accounts receivable part of the selling price? How do you calculate them? You could determine them at closing. You could say, hey, I'm going to purchase the accounts receivable. You have $100,000 of accounts receivable. We're going to look at your historic collection percent. We'll pay you those out, and maybe the buyer would retain a 5% collection fee. Or we'll see often arrangements where we will pay out the accounts receivable as they are collected for a period of time, typically somewhere in the 6 to 12 month range after the sale. Number two, supplies. So the supplies are the inventory of the practice. Common methods would be looking at 1 or 2 months of the prior 12 months expense as the value of the inventory on hand. And this is where there could be big differences between a general practice or a specialty practice as far as the amount of supplies that they have on hand, but that's one or a way to look at the value of those supplies. What's also there? There's equipment. Equipment is a big piece of a dental practice. This one is, in particular, is why I think it's difficult to simply look at a collections multiple, because you do not know the state of the equipment. Is it brand new? Is it all digital? Or is it very, very old equipment and everything's on paper? If you're simply just looking at a percent of collections, you don't know that. So we like to look at the equipment and value that. If there's big pieces of equipment, an appraiser may have to be brought in. Very often for dental equipment, we'll look at it and it's appraised at about a 12-year life, and it's called straight line depreciation. So meaning if you bought a piece of equipment for $100,000, you'd take off $10,000 every year. So 5 years later, that equipment would be worth $50,000. And typically at the end of that 10th year, it's not worth zero. There would be what's called a salvage value. There's still some value there, so perhaps that's 10% of that historic cost. So that is a way to look at and value equipment. Leasehold improvements, often done with a similar mentality or methodology, as equipment, as far as maybe the leasehold improvements have a life of 15 years, for example. The building. So the building is really a non-operating asset. So if the building is going to be part of the sale, there's very likely going to want an appraiser brought in to value that building separately and not have it as part of. And buildings typically have a very consistent cash flow, and they could be valued in slightly different ways and not at the same multiple, say, as your practice. So you really want to look at the practice separately from the building. Kelly's going to hop in here.
One other comment on the accounts receivable for people to keep in mind when you're looking at running reports off your billing software. Remember that the value of the accounts receivable is at gross. And what I mean by gross is that isn't necessarily the amount you're going to collect. Depending on your individual practice, what payer contracts you have, if you're in discounted plans, those discounts are not taken until the receivables are collected. So when you're determining that tangible asset value for accounts receivable, you would have to start with the gross value per your receivable reports, multiply it times an estimated collection percent to get to the realizable amount of accounts receivable, and that's what you would use in an asking price or that portion of the value.
So then we just went over the tangible assets. Now we're going to hop into the intangible asset piece. So the intangible assets, so what are that? So that's really the goodwill, also known as blue sky. So this is it's the right to earn income off of a block of patients in the future. So this is that income stream that you're buying. It could be either a personal goodwill or enterprise goodwill. Now, this starts to get pretty technical tax-wise as far as how do you transfer your personal goodwill to the enterprise. So I don't want to get down that rabbit hole, but there is a difference, and ultimately it comes down into those tax implications in there, so it is something that does need to be planned for. So it's goodwill, and then what could be a range for someone's goodwill? So for a general dentist practice, the range of goodwill that we're seeing is about 1 to 1.5 times 1 year's net income before dentist compensation. What do I mean by that? I mean the collections of the practice, so the cash receipts, less an adjusted normalized overhead. Normalized meaning if that dentist owns that rental, the building, they may have a rent that's not at fair market value. So if we make that, normalize that rent, get it at fair market value, what is the income after the regular operating expenses that's available to the dentist? So we're going to look at that income amount, and it would be then a range of 1 to 1.5 times that is about what we're seeing in the marketplace. The values are trending higher in the past 5 years, and this kind of gets back to when I was originally talking and I said there's purpose and there's standards of value. So there's a fair market value is typically what's considered what would, an arm's length transaction be for unrelated parties. There's also a piece that's called strategic value. So meaning, is someone trying to make a strategic move? For example, is someone trying to get into this marketplace? Are they trying to, do they already have some efficiencies by having multiple locations and that they could bring another practice in and cut some overhead? So because there are more strategic buyers in our current marketplace in Wisconsin, that has led to a trend in higher values in the last 5 years. So we're going to move on to the next slide, please. So determining the practice price. So again, I touched on this before, but so the asset sale, and it's very important, so I wanted to bring it up twice. So the practice price can represent all or any combination of the tangible and intangible assets, but it excludes the liabilities. So while we talked about accounts receivable was a tangible asset, that may or may not be part of that sale. Could be a large cash balance on the books of that practice. Is that going to be one of those assets that is or is not included in the sale? But in general, why an asset sale is a higher price? Because it is excluding the liabilities. In the stock sale, it's all assets, all liabilities are included. That enterprise is continuing to exist as is. So I'm going to transition to Kelly now. So we've talked about how we, very, very high level, how you value a practice, how we like to approach this valuation process. And I'm sure a lot of people are very excited to or would like to know, so what are the value drivers? How do you increase the value of the practice?
Okay, so on the slide in front of you, we've written down a number of items that we've seen that have been important considerations for buyers when they're looking at practices. One overriding thing I want to make sure you as a seller have in mind is that who the potential buyer is does have some impact, okay? When we're working in the valuation world, as Justin touched on, there are different premises of value. There's fair market value, there's investment value, there's fair value. A lot of those are driven by who the buyer is. For an example, fair market value is a valuation of an entity that's done not assuming any particular buyer or seller, and neither are under any compulsion to transact, okay? So that means you can't say, hey, my practice is sitting here and I know that I have XYZ consolidator that is interested in my practice. If it's a fair market value valuation, you cannot take that into account. You just have to say, of the entire universe of buyers, what is my value worth? So in a lot of cases, we use the word valuation fairly generically. What we were really doing here is determining an asking price or a practice price that you are willing to ask, Okay, so these value drivers come into play when we get into that, and specifically depending on who the buyer or the most likely buyer may be. So we'll go through the list here of a few things. You can read them with me as we go. So certainly top line revenue growth over time, consistent growth in top line revenue, very attractive to a seller or to a buyer. Reason being, you have 2 years, or a year it's moderate, a year it's moderate, a year it goes down. Most recent year you increase 15%. Okay? As a buyer, they're going to look at that going, well, what potentially happened in that year? Did we have a big run-in up on accounts receivable the year before and we just collected it in that year with higher revenue? So a consistent, steady stream of revenue and revenue growth is a very important value driver. Okay? Kind of an offshoot to that is a healthy and consistent level of new patients. People want to feel that the practice is vibrant, okay, that you're attracting new patients, that the infrastructure is in place for those patients to continue to come to the practice after the seller leaves and they are in place as the new practicing dentist. Okay. Number 3, very important to keep in mind, the sellers or the services provided by the seller. What I mean here is, are there services that you are currently referring out to outside dentists, endo, perio, ortho, fill in the blank for any of these type services? Are you referring all those out? Because in this day and age, a lot of the buyers of these practices are trained and are doing those services themselves. So they view that as a real positive and a revenue enhancer to your practice. If you're referring out all your endo and all your perio, and you have a buyer coming in that does a lot of endo, for instance, that's a hidden revenue source for them that increases the value of your practice. So it's important to know how much of that is being done in turn, and to present that to the potential buyers that, hey, understand, I'm not doing any of these other specialty services. They're all available for you to keep in-house and generate more revenue. Number 4, on the staffing, specifically in the general practices, we know how important having the relationship is with hygienists and the patients. So the ability for the staff to stay, how long they've been there, are they going to stay on with the practice? I'm looking at one right now where, as we're looking at the practice, we know of a 31-year hygienist that we've been told is probably going to leave the practice. That's a negative revenue driver for us. That creates concern as we look at that and could potentially reduce the value. Facility lease transferability. A buyer comes in, you've got a 5-year lease. It's a prime location. They are going to want to make sure they have the ability to stay in that location and capitalize on it. So watch your leases and see if you have a clause in there to assign your lease to a potential buyer. Justin touched on the equipment, the quality of the furnishings and equipment. Active patient count, many buyers are going to want to get an idea for that. It fluctuates between practice. You'll see different definitions. Some people will say patients seen in the last 12 months, some in the last 24. We like to use 18 months. And then they will look at that factor, active patients on an annual basis. It kind of feeds into the patient growth. But what it does is if we see really high, consistent new level of patients, we don't see any revenue growth, and we don't see an increase in active patients, we know we got leakage out the bottom end of the practice, and that's a potential problem in looking at this. So a lot of these feed in together and support, hey, I've got a very vibrant, productive practice for you to buy. The profitability, I put revenue less overhead. Justin touched on that. That's an important component when we're valuing goodwill if we're using a multiple of the operating profit. The transition plan of the seller. And again, specific buyers or sellers or specific buyers here have different outlooks on this, but are you as a seller willing to stay on? Will you help transition the patient base? Do you plan on leaving immediately? Do you have any health problems that are going to prevent you from staying on in the practice and working? So the transition plan and having an idea of what you're willing to do. Most sellers are flexible on this. They don't want to stay on long term. They will stay on at some point in time. I will tell you from experience that most of the transition plans, the buyer will put something in that we want you to stay on for at least a 6-month period, perhaps 12 months. Usually by the end of the 2nd month, everyone's ready to rock and roll and the buyer or the seller is out, okay, just from experience. Number 10, another important consideration, who your buyer is, okay? The payer mix. 2 examples. You have a practice, you accept no contracted plans, you aren't in Delta, you're out of network everywhere, okay? Your buyer is in network with almost all payers. They're going to buy your patient base, meld that or take that practice over, and they are immediately going to start taking discounts on work that in your revenue stream you are not taking, okay? So that's something to keep in mind with your practice, especially if you take no discounted plans, that may be a negative factor for some buyers if they know that they're going to have to absorb those discounts. So you may want to look for, in that case, somebody who is looking to buy and perform the services so they can just continue on being out of network. And then fairly obvious when your fee schedule, just make sure your fee schedule is up to date because, again, if it isn't to market, you're leaving revenue on the table, which goes right back up and drives line number one in terms of top line revenue growth over time. And transition to the third piece here then, so now we've got an idea what the practice is worth. We know the things that are going to drive that value, what we should focus on. Now we've got this period of, we get this question a lot, like, okay, I'm thinking of selling my practice. What should I be doing? Okay. Obviously, the previous slide with the value drivers, that's a good sheet to keep in mind because those are the things that are going to be looked at, and they're going to be looked at over time. So you're going to want to be focusing on all those items, either have them in place, be prepared to have them in place, or be implementing them to drive that value when the ultimate day comes. So this is just a summary then of we took a 3-year window before. What are you going to want to do? Some are fairly obvious. Okay, you're going to want to maximize your production and revenue. Obviously, it's going to drive your top line growth. If we're working off an income multiple to figure value, it's going to increase your income or your practice price. Cut overhead. Okay, practices have varying levels of definitions of what they call overhead or not. So this is a point in time where if you have any, for lack of better term, fluff in your overhead, you may want to be cutting that out. Again, we're creating more profitability in the practice, which is going to be used as a determining factor for how we're valuing. Focus on new patient growth, kind of self-explanatory. Obviously, portraying that it's a vibrant, healthy practice. The lease considerations, if your lease is coming up in this window and it may cross over, that's something you want to enter into with the landlord and see if you can get that clause in there about assignability of the lease. If you have things in the office aesthetically that you can do to improve the appearance, you don't want wallpaper coming off the walls, you don't want baseboard, falling. You want to obviously present a very attractive and healthy picture of the practice to the buyer, so get those aesthetic things cleaned up. Obviously, assemble a quality support team to assist in the sale. You want to make sure you're getting the most you can get for the practice, and the valuation, the negotiations, et cetera, are all part of that. And then, very importantly, the last piece is be prepared to be an advocate for your practice. We see this very often when we come in and help practices that we don't work with, that the seller really doesn't know. They know their patients, they know how to perform dentistry, but they don't know how to sell their own practice. They don't know the positives. Why should that buyer buy my practice over the other practice down the street? Be an advocate, be prepared to have that information available, and be a salesman or person for your practice.
All right. We are just about out of time. We have about a minute left, and I know that we want to get you out on time because you have patients to get back to. I want to thank Justin and Kelly. If you do have a question, we do have a couple minutes that we can stay on. Just chat it in the chat feature on your PowerPoint. Just type that in and we can answer your questions. While we wait to see if we do have any questions out there, I do want to mention that we have some other upcoming webinars in the SVA Dental Webinar Series in July. They are complimentary. On July 16th, the topic is Mid-Career Financial Planning Strategies, and on July 18th, it's Nearing Retirement Financial Planning Strategies. If you're interested in one of those topics, which I hope you do to maximize your retirement, you can register at svaaccountants.com/events. Looks like we are out of time, so we will let you go get back to your patients. If for any reason at all, if you have any questions in the future, both Kelly and Justin's Contact information is on your screen. Feel free to reach out to them at any time, and they can help you out. I would like to thank Kelly and Justin again for this presentation, and thank you all for joining us today. Have a wonderful day.